All right, well, take a look at tech stocks. Tech generally has reached unprecedented levels, not only in terms of the price action, but when you look at a metric like price relative to sales, we are trading at extremes. The tech sector now trades at 10 times sales, and that's just the average. Many are significantly above that, and as you can see, that's even higher than what we saw during the dot-com era. Is this a problem, or are those sales going to catch up to where the prices are? David Dietze is managing principal at Peapack Private Wealth, especially when it comes to tech. David, valuation not necessarily always the best in terms of predicting returns.
Yeah, absolutely. So the problem with valuation is it can tell you when you have a potential problem, but it does not tell you when that problem is going to manifest itself. But there is worries, and I think that investors do need to be prepared. As you mentioned earlier, we have never seen a tech sector trading at this multiple of sales. At the end of the day, I'd like to look at price to sales because it's hard to manipulate sales. The money either comes through the cash register or it doesn't. Earnings, of course, there's all sorts of depreciation and deferral aspects and whether a stock option should be expensed now or not. But sales kind of tells you the truth. And of course, a lot of it is due just to Nvidia, which is trading close to 40 times sales. It's in some ways outrageous.
Outrageous, but also makes you a lot of money if you just hold on to it. What do you do with it?
Yeah, absolutely. So I guess it depends on your view of AI. I mean, two things can happen. One is AI can fulfill all our fondest promises of, productivity and new ways and revolutionary ways of doing things. But then, of course, even then, you have to wonder how much have the profits from AI been brought forward? Or alternatively, you can say maybe this AI is overhyped. It's kind of like streaming was a few years ago, or the metaverse, or the promise of cannabis, or a lot of other things that just have not actually transpired. Because of course, even if AI is great, how many competitors are going to be there? What will the average consumer pay? As much as they're paying for Google search. Where does the government fit in? Certainly, Sarah Johansson's not too happy that allegedly her voice was just ripped off and used in an AI setting. Can all the providers of digital information, can their information just be scraped without either attribution or even payment? A lot of questions here. And so I don't think that you can assume now there's just rosy skies ahead.
Those are a lot of questions I don't think investors are asking because they just look at their returns. Even if they just bought it a couple of months ago, it's up so significantly. So your advice now on the stock is what? It just seems like you're willing to maybe watch this from the sidelines, even if it means missing out.
Well, certainly, I mean, almost all investment advisors are looking at the percentage, even in the indexes now, that just a couple stocks, Microsoft, Nvidia, and Apple constitute. And of course, they're all in the AI business here. And so they're like an asset class in itself. I think, the top 10 stocks are, 35, 37% of the S&P 500. So what I'm concerned about, Amber, is a lot of people say, hey, I would never just gamble on Nvidia. I'm in a low-risk, low-cost index fund. I'm immune. But if it's an S&P index fund, you are not immune because almost all the gains. Indeed, if since 2021 you just had the equal-weighted S&P 500, you would have made no money. All your profit has come really from the gains in the market cap S&P 500, and most of that's attributable to the mega cap techs and the AI boom.
So that's a great point and great perspective. It also highlights the fact that there's a lot that hasn't participated in the rally, which if you're a buyer of stocks could be an opportunity. Where are you going hunting in some of the forgotten areas of the market?
Yeah, absolutely. So we're looking at energy, we're looking at financials, we're looking at real estate, we're looking at smaller companies. Indeed, going back to that price to sales metric, the Russell 2000 is trading at a lower price to sales ratio than is average over the last 5 years. And even if you like tech, we all like, the excitement and new things that tech provides us. Consider looking at tech stocks in the Russell 2000, which are trading at an average price to sales of 2.8, which is less than the S&P 500 as a whole. So you can get your tech and get it at a bargain price too.
You mentioned energy, and certainly Canadian investors know that energy stocks have not been performing well recently. I assume you're maybe shopping, picking up some names south of the border where you are. What's your preferred name in energy these days?
Yeah, absolutely. Chevron comes to mind here. Of course, it's one of the top 2 integrated energy companies in the world. Why do I like Chevron? I think it's an opportunity here really for 2 reasons. One is we have seen fossil fuel prices pull back. It's kind of the so-called taper tantrum as people are expressing concern over relaxation in output restrictions in the Middle East, perhaps starting in the fall. We think some of that may be overdone, hasn't yet materialized. Second, of course, is confusion as to what's going on with the blockbuster merger between Chevron and Hess. Both parties have agreed to it. The fly in the ointment, of course, a major fly, is that there's a contractual provision which calls into question Hess's right to transfer effectively the Guyana off Brazil energy site without Exxon having a right of first refusal. That, I think, is also keeping people on the sidelines. But meanwhile, of course, you got this 4.3% dividend in Chevron. Remember, that's about the same as a 10-year Treasury. Why is Chevron better? It has hiked that dividend, not just regularly. We're calling it is a dividend aristocrat. Has hiked it more than 25 years in a row. That's an important thing. Worried about interest rates, worried about debt. Chevron has one of the lowest debt to assets ratio in the whole energy patch at only about 7%. So in a worst case scenario, they could borrow to keep that dividend streak going. We think Chevron does well so long as oil stays above $50 a barrel. If it moves up higher, a lot of AI players are going to be looking over their shoulder at Chevron.
You know, we're talking about Nvidia kind of being in the elephant in the room. You can apply that same sort of thinking to the healthcare sector because the Eli Lillys of the world are masking what is uneven performance within healthcare. I mean, half of that index is actually down. Are you looking for opportunities there as well that maybe don't have that same sort of Eli Lilly halo effect?
Absolutely. And of course, one of the reasons that people are leery of the healthcare sector is because we're coming up to elections, and the healthcare sector is an easy asset class to bash by parties on both sides of the aisle because of the expenses imposed on the American people. But I think in terms of investment, check out Bristol-Myers Squibb. Now, it had one of the worst earnings performance in Q1, where it had write-offs of all sorts of acquisitions it had made. Instead of making about $6 a share, is going to make this year about maybe 47 cents a share. However, revenues kept moving up nicely. Free cash flow still looks to be about more than 10% of their market cap. It gave them the political capital within the company to announce a $1.5 billion expense reduction, eliminating jobs left and right. And analysts are now projecting that Bristol-Myers could earn $7 next year. Well, that looks pretty good on a $41 stock. And of course, you have a dividend that's at 5.8%. Notice they have not cut that dividend, notwithstanding the volatility in the earnings. And of course, this is the company that bought Celgene in 2019, one of our leading biotech companies. There's all sorts of products in the pipeline at Bristol-Myers. We think this is an opportunity to take advantage of healthcare weakness and a stock that announced a very poor earnings, but we don't think that's going to be continuing, and the stock is oversold.
All right.